Since 2021, much of the financial narrative has been around inflation, which maybe turned out not to have been as transitory as central banks would have hoped. Then it was the most aggressive tightening cycle that we'd seen in decades, and more recently, it's been about when and if we're going to get more of an easing situation. So Eric, we're going to talk mostly about US-based interest rates here today, but I was hoping you could start us off by giving us a landscape, a global landscape. What's your view of interest rates around the world?
If you look around the world, you see that there was this tremendous global surge in inflation that hit every economy except one. China was the only country that seemed to be spared higher inflation. And now all around the world, inflation rates are receding quite rapidly. Across all of the major economies, annualized inflation was slower in the second half of 2023 than it was in the first half of 2023. So the trend is heading in the right direction. And so the question, I think, for a lot of central banks is, when do they begin easing? If you look at the forward curves in our markets here in the US, in Euro-Ester futures, for example, as well as in Canada, Australia, the United Kingdom, they're all projecting that the most likely outcome is rate cuts. But the question is when and how much.
Okay, and then here in the US, we had an inversion of the yield curve between the 2s and the 10s starting way back in July of 2022. And that inversion reached, I think, 100 basis points a couple different times. So we've had not only a deep, but also a long inversion of the yield curve. Now it's trading around 23 basis points. So Jim, can you talk about what factors impact the yield curve both at the long end and the short end? Because there's different things that impact those two tenors, if you will, right?
No doubt. And when the curve goes inverted, it's always been a reasonable predictor of a coming recession. And to put it in the simplest terms, because what the market is telling you, this smart money, if you'll call it, is that rates will be lower going forward, meaning that if the recession's coming at some time in the future, they're going to have to lower rates to accommodate the coming recession. And we've had that for like you said, since July. So this has been one of the deepest and one of the longest inversions in almost 50 years. So does that mean the recession is going to be one of the worst? No, it doesn't. The predictor becomes more reliable with deepness and length, but it doesn't at all give any clues as to what the level of recession is going to be. But what's been interesting, just in the last couple weeks, we have the Fed chairman coming out and saying, I don't know what you guys are thinking. I'm paraphrasing, of course. I don't know what you're thinking about eases, but they're not coming when you guys think they are. That's not what he said exactly, but it was close. And then 2 days later, we got what looked like a stronger than expected unemployment number. So all of a sudden, the market started to believe that he's not easing. Then all of a sudden, we start to hear rumblings of regional banks, and the market is wondering, like, wait, that's the balance that's happening here? Is there could be some fissures in that sector that come into conflict with what we think is a decent economy? Does that make sense?
That makes sense. Eric, do you have anything to add on what Jim said, just in terms of how the short end and the long end of the yield curve relate to one another and what might move each?
Yeah, so the central bank has almost complete control over the short end of the yield curve. They can really set interest rates wherever they want, at least in theory. Now, in reality, it usually seems that interest rate markets anticipate where they're going well in advance. Sometimes the central banks resist what the interest rate markets are telling them, and then catch up later on. That was certainly the case in 2022 when the central bank didn't seem to think it was going to raise interest rates as quickly as the market thought. It turned out they were both wrong, and they raised interest rates a lot more than either one thought. Yeah, when it comes to the long end of the curve, there are different influences. There's long-term inflation expectations, which seem to be pretty contained. If you look at the various surveys, like the University of Michigan Consumer Sentiment Surveys, they suggest that inflation over the long term is likely to be close to where it has been. Could turn out to be wrong. The other thing is debt issuance. The US government is issuing tremendous amounts of debt, $760 billion this quarter. And so it's a lot of treasuries coming onto the market.
I've got to take the opportunity then to get Jim's take on the debt issuance, because I've seen a lot of his writing, I've seen some of his opinions, and so Jim, give us your base case on just how big the U.S. debt has gotten.
Okay, it's gotten ridiculously high, and they're spending money. If they come out and tell us that the economy is so good, then it is a very reasonable question to ask them, why are we spending so much money? If from Keynesian economics, that would be if we were doing that to handle a slowing economy, not what's supposed to be a blossoming economy. So to me, there's one thing that's really interesting about the debt issuance right now. Right now, the Treasury is going a lot to the short end of the curve because there's a ton of money and cash that's still left in reverse repo markets, and they're taking the low-hanging hanging fruit. That should be gone by about the middle of summer. And that's, if anyone wants to get into that, it's not as complicated as people make it out to be. It's just extra money that the banks have that they need treasuries for, so there's demand there for treasuries. Well, as soon as that's gone in June, the Treasury has to start going further out the curve to sell bonds. And we've seen in the last couple months a couple long-end bond issuances that didn't go that well. So the appetite for our bonds is going to be interesting. I'm not saying that everyone's going to back off and not buy U.S. bonds. We're still the United States. We're still the reserve currency. But I think that at that point in time, it could spark the Federal Reserve to come back into the market and not do the quantitative tightening anymore, where they're essentially selling bonds, but not really. They're letting them roll off. But I think they could possibly come back in and start buying bonds. And I'm interested to hear if Eric agrees that that's a possibility.
Well, it is a possibility. This is not the first. This is not the Federal Reserve's first attempt at balance sheet shrinkage. They were shrinking their balance sheet from the fall of 2017 until the end of 2018, when they ran into problems in the repo market. What did they do when they ran into problems in the repo market? They did a little mini QE4. They started printing money again to sort of normalize that market. Even in the midst of this balance sheet shrinkage, last year, when we had the failure of Silicon Valley Bank and First Republic Bank, there was a 1 or 2 month period in which the Federal Reserve stopped shrinking its balance sheet and started expanding its balance sheet again. So at some point, there could very easily be a trigger, whether it's an economic downturn, banking problems, problems in the repo market, something could trigger them to start another round of QE.
Can I add something to what he just said about the SVB too? So what they did back in March when SVB was going under, they said they'd buy all the bonds at par. Well, the problem was those bonds weren't worth par. So that's why they're boosting up their balance sheet. It was, in fact, a QE by a loose definition of QE.
Yeah. And you mentioned a couple auctions that didn't go well. I think some would say that's an understatement on a couple of the recent auctions. So
Trying to be kind.
I understand, Jim. So moving on, and both of you guys provided a nice segue into this. At the January FOMC meeting, we know the Fed held its target rate steady. But the Fed funds market still doesn't seem to agree with what Fed Chairman Powell continues to say. Eric and Jim, what are your views on this?
You're right. There is a gap between market expectation and what the Fed's saying. The Fed has been saying now for over a month that they're thinking about cutting 75 basis points later this year, but probably in the second half of the year. What the market is pricing is the market after all of this data and after Powell's press conference has sort of mostly eliminated the idea of a March rate cut. Now, in my sort of experience of watching these sorts of things over long periods of times, after inverted yield curves, which we talked about earlier, often what happens is the central bank resists cutting rates for some period of time, then they start cutting slowly, and then they cut a whole bunch. It would not surprise me if we wind up with rates much, much lower than either the Fed or the forward curves thinks we're going to get.
Interesting. What's funny is that the Fed funds futures market has been predicting eases for quite a while now that haven't come true. So we always, as traders, think that the smart money is usually right. Well, it hasn't always been right. But to Eric's point, and also too, the Fed funds is a hedging tool as well. So sometimes it tends to overstate what the market really believes. Sometimes people have to price in what could potentially happen. So that's where those 5 eases come in. I do think that what's going to happen within the next couple quarters. And you look at the labor data, and the labor data, like you said, it seems strong. I think if you look under the hood, there's some serious problems. The household survey does not agree with it. The ADP number does not agree with it. And even the way they collect that headline data, the survey model, has broken down a bit since COVID. So I don't think the labor market is strong as they think it is. And I think if we start to see problems in the banking system and problems at auctions, all of a sudden the Fed will be activated again. And to underscore that, back in March, when Silicon Valley Bank had a problem, they flipped into rescue mode in about a day. So they can talk tough all they want, but oftentimes when burning timbers are falling from the ceiling, they act quickly.
Right, so things can change quickly, and it sounds like you guys are generally in agreement, too, in terms of kind of what you're seeing, both in what the Fed's saying and what the Fed funds futures market is saying. So switching gears yet again, let's talk about some products that people might use to take advantage of a view on either the direction of a particular point in the yield curve or the yield curve itself. And here at CME, we have interest rate futures products from T-bills, Fed funds that we just talked about. We have short-term interest rate products called SOFR, and then we have an entire suite of Treasury products. So we've always had the traditional Treasury products from 2s all the way out to what we call the Ultra 30-year bond. And those are futures products that are quoted in price. They're deliverable products. There's convexity, we won't get too much into bond math. But more recently, we've introduced Treasury yield contracts that are quoted in yield, they're cash settled, they're based on the on-the-run Treasury, and they're smaller size. So Jim, I'd like to hear kind of your take on how a trader might use these yield-based products to take a view on the curve or a certain part of the curve.
So first of all, I love these products. I've been brokering interest rate futures for 35 years. And it is somewhat confusing, the fact that price moves in one direction, yields in the other. I think an average retail trader who's not just looking at interest rates, who may also be trading stocks, also be trading commodities, it is so much easier to relate to interest rates by a product that's priced in yield. And then you talked about the curve. Prior to this, if you wanted to do a 2s10 spread and you had to use the conventional futures, there's ratios involved, and it's a difficult thing to do, and there's a lot of math. This just takes that all of it out. I rolled it off at the end of the month, but I had a steepener trade on using the micros, and I was so much more comfortable doing that because you can just mark it by looking at the curve, looking at the prices. So I think these were a tremendous addition for traders who look at a lot of other things and can't just devote 100% of their focus to the traditional futures.
Yeah, that spread execution is a good point too, because it's a 1-to-1 and there's a spread quoted market on the screen. So you can do, for example, a 2s versus 10s spread in one execution, one efficient execution. So it's a great point. Eric, what do you think about the different products that CME's got in order that somebody could use if they wanted a view on the interest rate market?
Well, I agree that the yield futures are a very interesting way to look at the market, especially the 2-10 spread, which I think could be a big mover this year, especially if the central bank were to cut interest rates. That would likely steepen a great deal. The traditional treasuries are also interesting. They're often used by big institutional investors, but the mathematics of them between the contracts can be a bit more complicated. They're very, very liquid products. And then at the short end of the curve, SOFR is massively, massively liquid. There's essentially a contract every 3 months out several years. And it's sort of the biggest, most widely traded interest rate benchmark in the world.
Right, and certainly we in no means want to short sell our traditional Treasury futures products, because for institutional customers who know bonds and know bond math, that stuff becomes second nature, and they know what 130 and 30 seconds means. For some individual traders, to Jim's point, that the yield just is a lot more intuitive when you see that quoted like that on the screen. So something I've always thought was interesting in the interest rates market is how much the rates impact different asset classes like gold and foreign currencies and certainly equities. Really, maybe there's not an asset class that an interest rate move doesn't touch. So just kind of wanted to get your opinion on that. Particularly recently, it seems like every time you see a big move in rates, you see a corresponding move in foreign currency and in gold. And it's maybe it's not stronger than it has been traditionally, but it seems like it's a pretty strong correlation these days.
Yeah, I follow the gold and silver market's response to interest rates very, very closely, and you're right. I would say that if you look at the one-year rolling correlation, it's about as strong a correlation as ever seen, and it's very negative. So gold in particular is a currency that pays zero interest. So what the gold market does not like to see is it does not like to see interest rate expectations shifting higher, which explains a large part of the reason why gold failed to rally even as we experienced inflation. Inflation rates are very high, but that caused the market to go from expecting essentially zero Fed funds up to 5% Fed funds, which was not fun for gold. By contrast, if you look back a few years earlier, from the end of 2018 to 2020, interest rate expectations came down from 3% down towards zero. Gold went from $1,200 to $2,100 per ounce, so an 80-some% rally. So it gives you an idea of what could happen if the Federal Reserve reduces rates more quickly in the end than the forward curve is anticipating.
And Jim, you're a trader. How can a trader look at these different relationships and take advantage of these relationships that exist between rates and some of these other asset classes?
As someone who's been involved in the rate market as heavily as I have been, I always believe that the rates are more important because they affect everything. They're like the dog, and everything else kind of becomes the tail. And not just in gold and silver. When rates were zeroed out for so long after the great financial crisis. It really, part of that point is that people get sick of investing in U.S. Treasuries and making nothing, and slowly they move out the risk curve. That's how you get people to come out and take risk in. And part of that is into stocks, and it starts with utilities and then goes all the way up to growth stocks, tech stocks, and things like that. So I think the rates being at zero for a long time was, I think, the biggest driver of the bull market. I know some people might question that, but I think it was. And then I think when rates were going higher, obviously the stock market got hit hard at the beginning of the rate cycle, but since that time, it's moved back because we keep pricing in lower and lower rates and a Fed pivot. I think it's going to happen this year. Gold and silver should do well. And again, I reiterate again that I think part of the pivot is going to be them reinstating some quantitative easing, which will they will buy bonds to keep longer rates low, but that could hurt the currency at the same time through money creation. M2 will rise, their balance sheet will rise. Then things like the lower rates, coupled with the fact that the dollar could be going lower at the same time, should do really well for commodities.
I think you're absolutely right, Jim. And it kind of brings us full circle because here at CME, we have products in all of the different asset classes we just talked about, upon which people can take a position on a view they have or hedge an existing risk.